energy is the global currency. You're going to be constrained as a society by how you can grow, how you can basically develop based on how much energy you're able to produce and how you're able to consume that in a efficient manner. You had to have a forest that was gonna be 10 times the size of your city to basically have the energy that you need. We've moved away from that. Energy sources are becoming much more efficient. Energy sources are being distributed much more efficiently. The crisis is going to be inevitable, I think, especially in the cyclical industry. It's too late to think about it when it basically happens. You can't prepare for everything. I was going out there because I knew I was going to find incredible individuals. I was going to have a perspective that was going to, challenge my view of the world, and that's exactly what I found. It's rigorous. You have to be able. You could be right versus the market. You have to be able to.
Today, I'm joined by Domenico Sansalone. Domenico is a finance executive and corporate treasurer at Expro Group Holdings, one of the world's leading energy services companies operating across 60 countries with over 8,500 employees and serving the oil and gas industry. Domenico's career path is, fascinating. He's a Canadian finance professional who spent nearly 20 years navigating the treasury and risk management functions of some of the world's largest industrial companies, from Rio Tinto's metal operations to ArcelorMittal's steel empire, before landing at the heart of the global oil and gas sector at Expro. Domenico also holds an executive MBA degree from the University of Oxford, bringing both academic rigor and hard-won practical experience to one of the most critical roles in the energy industry, deciding where billions of dollars should flow in an uncertain energy future. Right now, the energy sector is at historical crossroads. We are being told that renewables are taking over, yet fossil fuels still account for roughly 80% of global energy demand. Fusion energy startups are raising billions, claiming commercial viability by 2030, while hydrogen is heralded as the fuel of the future, yet it faces massive economic and scaling challenges. Oil and gas companies are simultaneously pledging to achieve net zero emission by 2050, while expanding LNG capacity and doubling down on carbon capture technology, all at the same time. So this episode really matters because Domenico sits in the decision room where these contradictions get resolved with real money. As a corporate treasurer managing capital allocation, liquidity, risk, and strategic financing for a company operating at every stage of the oil and gas well life cycle, he sees what the public never does. The actual scenarios energy giants model, the technologies they truly believe in will scale, and the cold financial calculus behind energy's biggest bets. We are going to explore the real battle for energy's future, how multi-billion-dollar decisions actually get made, and which technologies oil majors are betting on to survive the next 20 years. If you want to understand where global energy is truly headed beyond the headlines and political theater, this conversation will provide you with the real perspectives of an industry insider. This is Business Unbound. Let's dive in. Quick moment of honesty. Business Unbound is brand new, and we're in the early days of something that I genuinely believe in, a show dedicated to real conversations with forward-thinking business leaders and inspiring individuals who are having a real impact on this world. And that's where you come in. I need your help. If you're watching this on YouTube, please like, comment, and subscribe to the channel. If you're on Apple Podcasts, Spotify, or any podcast app, follow the show and leave a rating. It sounds simple, but it shows the algorithm that this content matters, and it directly impacts how many ambitious professionals like you discover these conversations. When you're helping me, you're not just supporting a show, but here's what you're really doing. You're saying that quality business conversations deserve a platform. You're saying substance matters over hype, and you're saying this mission is worth building. So if this resonates with you, help me reach others like you. Subscribe, follow, share, whatever works for wherever you are. You're helping build something substantial from the ground up, and I genuinely appreciate it. So thank you. And now back to the show. Domenico Sansalone, welcome to Business Unbound.
Thank you, Florian. Pleasure to be here, as always.
Domenico, you're a senior finance professional and executive and currently corporate treasurer at Expro, a major energy services company. But your career really began in metals and mining at Rio Tinto. Can you take us back to the beginning? What first drew you into corporate finance and treasury, and what was there a moment when you realized that this path was the one that you wanted to pursue?
Yeah, thanks, Florian. I ended up in finance almost by chance. Realistically, I had studied pure and applied sciences in college. I had started off actually in orthotics and prosthetics, so I was doing artificial limbs for amputated individuals. The objective was going to be to do biomedical engineering. I had started off actually in engineering at university, but my father had a company. I had helped him out in the summer through finance. Um, One thing led to another, and I decided to switch over to finance and never looked back since.
And how about metals and mining in particular?
So metals and mining, Alcan. So I grew up in Montreal. Alcan was by far one of the largest companies in Montreal. At the time, I was lucky enough to be part of what you call a co-op program at university, and my first internship was actually with Alcan, which was the aluminium company that at the time then got bought out by Rio Tinto. So I worked at Rio Tinto Alcan, basically on the aluminium smelting side.
Hmm. And you eventually ended up spending, well, I think it was nearly 1 decade at Rio Tinto and, well, progressively senior management roles during a particular volatile period for commodities, I would assume. If you go back to this time, what were the biggest lessons that you learned about managing financial risk in, I would say, a cyclical and very capital intensive industry?
Yeah, so I think I when I started off at Alcan, basically, obviously we're just an aluminium company. Back in 2008, Rio Tinto decided to acquire the company for about $40 billion. At that point in time, Rio Tinto had no debt on balance sheet. This was really the first large acquisition funded for them through debt. Unfortunately, within 1 year, the Lehman Brothers crisis happened. Commodity prices went for aluminium, at least, or aluminum for your American listeners, went from $3,000 a ton to 1,400. When you're producing 4 million tons a year, that's basically $6 billion of revenue that suddenly disappears just on the back of an acquisition of 40 billion. So, look, what did I learn from a Rio Tinto perspective? Obviously, markets could turn really quickly when you're looking at models in terms of either acquisitions or in terms of what your long-term strategy is. It's important to understand what the assumptions that you have behind them are. It's important to understand, the upside, the downside as well. And I guess from a Nassim Taleb point of view, what the black swans are, what could happen, what could go wrong. At that point in time, obviously, we were hedging a lot of our production. That means lots of margin calls as well. So from a cash point of view, that was, let's say, maybe a unexpected pain from Rio Tinto following the acquisition.
Can I just bluntly ask? I mean, this event and the aftermath of the Lehman Brothers collapse. To what extent does or did what you experienced still shape how you think about risk management, financial risk management today?
Oh, look, it still shapes. I mean, today the biggest lesson there is that the crisis is going to be inevitable. I think, especially in the cyclical industry, it's too late to think about it when it basically happens. You can't prepare for everything. But for example, in a corporate treasury point of view, the biggest risk for us is liquidity. The one thing that treasury can get wrong is basically liquidity risk in terms of funding the company. And you can start looking at that when you actually need liquidity. It takes years ahead of time. I mean, I have bank dialogues daily, even when there's nothing to fund, just to keep them abreast of what's happening in the company. So that whenever we do need something, um, foreseen or unforeseen, either for capital growth or even for basically cyclical hiccups that might happen throughout, we're ready. And they know who we are. Their credit teams know who we are. It's much quicker. It's too late to scramble what basically, or it's too confusing to scramble when the crisis hits.
Let's get back to your career and how you moved through your different positions. So in 2012, you then moved to ArcelorMittal, the world's leading steel company, during a period when, well, the steel industry, and I think it's still true, faced intense pressure from overcapacity and in particular Chinese competition. So I'm wondering, what was it like managing liquidity and funding in that environment? And, well, how did that experience prepare you for the oil and gas sector, perhaps?
Yeah. So just how I ended up at ArcelorMittal, first of all, because that was based out of Paris. I'm married to a French incredible woman. Basically, we met in Montreal. At the time when Rio Tinto had acquired the company, they obviously, as I just said, had spent $40 billion. Market was going sideways. They actually went into a divestment phase. So they made it very clear at the time that they decided downstream was gonna disappear. So I actually went to Europe to set up what got bought out by private equity by Apollo, which is now IPO'd, called Constellium, which was basically the extrusion and downstream aluminium section. That was so I set up the Treasury department there in Zurich. Um, at the time, my wife didn't want to move to Zurich, so we came back to Paris. And again, one of the opportunities there through commodities would have been ArcelorMittal. So I worked within the corporate finance department of ArcelorMittal. Just to be clear, within ArcelorMittal, obviously I was in Treasury. I was on the corporate finance side. There was a whole team basically there. So I was part of a slice of, let's say liquidity, not the entire liquidity portfolio. ArcelorMittal at that time had about $20 billion outstanding debt. The company had gone from, just to put into perspective what you're talking about in terms of cyclicality, $7 billion per quarter of EBITDA to, at that point in time, $7 billion of EBITDA per year. So basically what they did in a quarter, they now did in a year. Now at that point, $20 billion of debt, stacks of debt coming up in short term, 1 year, 2 years. The maturity stacks were pretty close by. There were two main things. There was the maturity gap to be funded, and there was basically the short-term liquidity to be funded. Most of my time there was on the side of making sure we had, again, the short-term liquidity, where I was able to discuss with the banks for $1 billion worth of short-term liquidity lines, 364-day liquidities, just to make sure that we had day-to-day the cash to be able to run the operations. And then obviously, globally as a treasury group, under a credit or a corporate finance lead, we basically had to refinance the stack to basically extend it out through the cycle. So
a few moments ago, you talked about downstream, and if there's downstream, then I would assume there's also upstream. And just for our audience who may not be familiar with how the industry works, can you explain in layman terms what downstream, upstream, what it means?
yeah, so to make it simple, in any industry that you'll talk about, upstream is basically the raw commodity, let's say, that you're producing, and downstream is all the adjacent industrial or commercial products that you're going to end up. So for aluminium, for example, the upstream would be, you need bauxite, which is a rock that you transform into alumina, which you then transform into aluminium through smelting. Then that smelting, you end up in various products. That's the upstream. The downstream would be, you have ingots, which are just basically a store of the aluminium, all the way down to extrusion, which be to be pressing that aluminium through presses, for example, to make the rails for trains. It could be rolling for basically cans for drinking. It could be industrial for the planes that we fly, Airbuses in particular, the wingtips and everything else. So the downstream is all the adjacent products that you use from the commodity itself. And in oil and gas, the upstream would be obviously the oil producers, and the downstream would be everything else in terms of again with your um, the not the fabricators, but basically the utilities behind it. That makes sense?
That makes sense. Oil and gas, I think it's actually a good segue, because then in 2015, you joined Expro, and you've been the corporate treasurer there for nearly a decade now, which is a long tenure in the treasury role. What kept you at Expro?
Tell me about it, Florian. It's a long time. So again, how I got here first. I was in Paris at ArcelorMittal, met up with the then CFO of Expro, which was at that point in time a private company. We're now a publicly listed company. Called me up. They were trying to IPO, or they were trying to see to get back to at least public status. So Expro had been public up until 2008. They got bought out by Goldman Sachs and canned over, took in private. And then by the time they got to 2014, as you know, would be normal, they were looking for an exit strategy, and that would mean basically monetization of the company or of the shares. So I had met the CFO at that point in time in Paris. He had told me, look, why don't you come over to Expro, do the same thing that you just did at Constellium, in terms of setting up the treasury department, setting up a finance team, to be ready for public status. And I had gone at that point in time through the IPO process with 𝐘𝐨𝐮'𝐿. Now, I shook hands with him in October 2014, told my wife we're moving to the UK. She was ready to move as well. We were all happy. We needed a change. Arrived in March 2015 in the middle of an oil crisis. So again, same thing. I was coming to a company that was supposed to be IPOing, which then a lot of markets closed off. Material debt on the balance sheet. We had at the time a term loan B and mezzanine debt from private equity, so a total of about $2 billion worth on the balance sheet. And yeah, it had to be refinanced. So it's been 10 years at Expro, but really it's been, I'd say, 3 cycles of 2 years each, or 3 years. It's been a very different company because it went from private that needed to actually restructure to basically public through a reverse merger where we acquired through share exchange a publicly listed company, to then growth cycle, continue to expand the portfolio, to now today basically where we're in a steady and growth phase, let's say.
And crisis is something that we will talk about later, most certainly. Before we go deeper, at some point in your career, you also decided that you wanted to pursue an executive MBA at the University of Oxford, one of the world's top business schools. That's where we met, obviously. It's a significant commitment for any professional. And I'm wondering, in your particular case, what motivated you to pursue this degree?
I was always a firm believer of continuous education throughout. You never stop. You never stop learning. And I think, look, I was surrounded by incredible people at work, but you always have one view. You're within one industry with the same people. You kind of end up without, I don't know if this is the appropriate term, but almost drinking the Kool-Aid, let's say, right? You're surrounded by like-minded people. And thinking back, I mean, there's something that my father always used to say, and I think I've told you this before as well. He used to say, it's a story where there's a farmer that has a field, and every year he basically wins a competition for the best corn. And then at the end of every year, he takes the seeds from the corn and he gives them to all his neighbors, and he tells them to plant them as well. And people tell him, look, you're naive. Why are you giving this award-winning corn to your neighbors? He says, because they pollinate my field as well. And I think that's what I was looking for in terms of Oxford. I was going out there because I knew I was going to find incredible individuals. I was going to have a perspective that was going to, challenge my view of the world, and that's exactly what I found. It's rigorous. It's time consuming. It's sometimes depressing in terms of, you have your stack at work and you have everything happening at Oxford as well, but it's incredibly enriching and challenging, and it's, lifelong connections as well.
You do it again?
I would do it again. Probably not the same way. I wouldn't do it with as much on my plate at work. I mean, but yeah, definitely I would do it again. Different, but again.
Fair enough. And now looking back across your 20-year career, spanning 3 major commodity sectors and multiple financial and other crises, can you identify 1 or 2 pivotal experiences, maybe a deal that went wrong or risk that you underestimated or market shock that fundamentally reshaped how you still think about capital allocation and strategic finance today?
Yeah, nothing ever goes wrong there, Florian. I've never made any single mistake in anything, so no. But I think, look, let's go through the 3 companies. Start off maybe at Alcan. There were, on the bauxite side, for example, considerable commitments that we had made in terms of bauxite mines in Australia, and they were going sideways. Yet we continued to invest in them. At the end, it ended up being the right decision, but at the time there were a lot of questions around it. I think you have to sometimes question, even in a corporate, why certain decisions are made. There's a lot of people element behind some of these things. We talk about risk as if it's only financial risk. Some things become pet peeve projects sometimes with some individuals. Sometimes some individuals have put their careers on certain projects. From a financing point of view, it's important to understand what decisions were made to go into the projects, first of all, and what's going to happen and why we're basically staying in there. So that's maybe the first lesson. Don't always assume that it's just because of a financial modeling decision that you ended up going somewhere. Know why you're somewhere and understand it. The second thing is, again, from a when we're talking about the commodities point of view, the crash from 3,000 to 1,400, we had all the right we had all the right metrics in terms of the hedging of the commodities. You know, you have to be able, you could be right versus the market. You have to be able to endure the market as well. You get a lot of cash calls, you get a lot of margin calls basically on certain positions. It's important that you explain, there's a lot of education around what it is that you're doing from a treasury point of view. Case in point, I used to get sometimes questions from upper management saying, well, we hedged. Why did we hedge? The price is going up. Had we not hedged, we'd have made a lot more money. Yeah, but we didn't hedge because we wanted to make more money. We hedged because we wanted to provide or protect a certain margin that we were all okay with. There's education sometimes that goes behind the decisions that are made. And the last thing I would say is that for sure, look, crisis is going to be inevitable, but oftentimes crisis is an opportunity as well if you're willing to endure it and you have a supportive group to help you endure it from a financing point of view. Not sure if that fully explains your question or answers your question, but that's my answer.
Look, I think even more importantly, you're saying something which appears to be a recurring theme when I compare with other interviewees that I had on the podcast previously. In every crisis, there can be an opportunity. If you see the crisis almost like as an invitation to improve and to question what you did in the past and to take lessons from it to apply in the future.
I think it was, I believe it was Xerox, the Xerox CFO that had made a very large mistake, something losing, these numbers aren't going to be correct, but let's say $40 million basically on a transaction. And the market was saying basically, they wanted his head. And the CEO answered basically saying, look, I just invested $40 million in his education, right? I.e., he knows the mistake he made. He's not going to make that again. Why would you get rid of the person now? So I think that as long as you have that mindset that mistakes will happen, obviously, I'm talking about mistakes that are inevitable, not basically, professional misconduct or gross misjudgment or whatever. As long as you're willing to learn from it, and as an organization you learn from it, there's going to be benefit.
Let's actually dive into one of the core topics of our conversation, the future of energy. And as a precursor, I just want to say the narrative that we typically hear is that renewables are taking over and fossil fuels are in terminal decline. Yet the data tells a different story. In 2024, global energy demand grew by over 2%, and fossil fuels still met about 80% of that demand. Oil demand, in fact, hit new records, and natural gas demand grew by almost 3%, and even coal increased. Now, from your perspective, working inside the energy industry in oil and gas, what's the disconnect between the political narrative around energy transition and the actual reality of global energy demand?
I think before we go into that, I think it's important to state that these are going to be my opinions, not necessarily the opinions of Expro. And anything that we go through over here, this is purely my view from my chair over here. Look, I think first, I don't think there is a discord. I think that it's basically in terms of expectations. Let's start off by why is energy important? I mean, if you look at it from I like a lot someone called Václav Smil, who's an author basically who wrote Energy and Civilization History. He calls it basically the only universal currency. It's going to be used to increase human capacity, harvesting it, converting it to whatever types of energy sources is going to be fundamental to our society. Now, with respect to your question on renewables, I think it's correct to say that they are expanding. They're an expanding part of our entire energy complex. And I think also if you look at the EIA report, future growth in energy consumption is probably going to be met by renewables, wherever those renewables are. So I think where the disconnect becomes is that we talk about transition as if transition means that there's no more oil. I'd like to remind probably your listeners that we're still using wood, we're still using coal. So there's never been a fossil fuel or any energy source that we've completely transitioned away from. The mixes change, the growth of certain fuels change over time. We're still using peat, right? Which is not a high content energy. It's not necessarily the most efficient, but that's what's available to certain parts of the world. That's what they use. So is oil and gas going to disappear at some point in time? I think the overall percentage of it will clearly come down in the overall complex. I think with most forecasts say at this point in time, which is very different to what 2023 was saying as well, EIA reports, is that probably it's going to plateau sometime in 2030. and then basically it's gonna either it slightly start declining at that point in time, or really stay for the next 20, 20, 40, 20, 50 years. So, is it still part of the complex? It's still going to be part of the complex. Is there still a future for basically oil and gas? There still is. I think realistically, it's going to be for the increased energy consumption that we're going to be looking at. That's going to be taken up by renewables, and then we could talk about what those renewables are. But that's my view of basically the transition.
And let's maybe make this even more concrete. For as long as, well, at least I can think, renewable investments and renewable energies have always been top of mind, multiple decades of renewable investment. And still, oil and gas remain very dominant despite these investments in renewable. Why is that?
I think there's three things. Hey, first of all, look, oil and gas from a utilization point of view is a high efficiency oil, right? From a in terms of converting to energy, it's something that you convert with limited basically loss. When you're looking at energy, in my view, you're looking at three components realistically: the financing of it, you're looking at the political incentives for it, and you're looking at basically distribution of it, right? In terms of taking it up the grid or everything else. Our system today is really catered towards oil and gas in terms of the distribution systems, in terms of basically the utilizations. Does that have to change over time? Absolutely, that has to change over time. But today, basically, there's considerable amounts of money that have been spent in oil and gas, and it's in everything that we do. I think a lot of people stop at oil and gas being transportation. The derivatives of oil, we're really good as a society using the carbon, using carbon molecules. It's in the clothes that we use, the synthetics that you're using. It's in plastics. It's in the roads that you're on in terms of, the asphalt. Fortunately or unfortunately, is the fact that it is everywhere. It's embedded in everything that we do today.
And you mentioned something which I think is interesting and noteworthy: energy efficiency. And look, I only found out about this more when I was doing research in preparation for our interview. And here's what I learned: that actually efficiency is one of the biggest challenges that renewables face, and something that is rarely being discussed in the public, which is energy density and grid constraints, or efficiency in other words. And as you mentioned, fossil fuels pack enormous amounts of energy into small volumes, while solar and wind are diffuse and intermittent, and infrastructure matters as well. From your perspective, how would you say that these technical or engineering barriers are being underestimated in public, if they are, related to the energy transition?
Look, you're talking about density. You're talking about basically, whenever we talk about energy, if you're talking about food, it's in calories. If you're talking about obviously energy, it's in terms of joules. Think of it like your diet. And again, I'm not an engineer, so this is my high level, take on this. You could have 5,000 apples, or you could have a piece of salmon. They're both going to give you calorie intake that you're going to need. You're going to need a lot more apples than you're going to need salmon. Now, move away from all the externalities, right? Food preferences, intolerances, long-term health consequences, whatever. Same thing for the energies you have. Just from a pure efficiency point of view, energy is a high efficient energy source. That's why we transitioned to it. Higher than coal, higher than all the other fossil fuels. Now, in your specific example, I don't think it's just a question of density. There's the issue of basically flows and stores as well. When's it produced? How is it stored? How is it injected in the grid basically for peak consumption? It's very easy in terms of oil to use it, or gas. Take natural gas. I mean, at the end of the day, lots of this energy is used for electrification. It's very easy to turn on a gas plant to produce basically energy for electricity. It's more complex in intermittent energies like wind, for example, or solar, to basically produce it, then store it, and actually put it into the grid at peak consumption times. I'll give you an example of what Alcan used to do, because and we'll talk about energy and those three companies that I worked for. When you look at aluminium, realistically, what you're doing is actually it's an energy play, because you're basically taking bauxite, like I said before, that you're converting into alumina, and then basically to aluminium. And that aluminium, basically, 1/3 of the cost of aluminium is basically energy. That's why you're producing a lot of it in basically Quebec, for example, that has no bauxite, has no alumina, has nothing, but they have hydro flows. They're able to turn on and off basically. They're able to turn on and off basically the electricity. When they have excess electricity, they put it into the grid. When they have not, when it's basically not peak time from a grid point of view, they use it to produce aluminium. You can't necessarily do this with every other energy source. That's I think one of the important things. And then as storage technologies improves, however, I think we'll see these energy sources grow, but we're always going to be confronted to the thermodynamics laws. Basically, the first one being that you don't create any energy. You basically nothing is created, nothing is disappears. Everything just transforms. And then the second thermodynamic is basically entropy. And I think it's basically entropy is what we're talking about here. As you're converting energies from one form to another, you'll always be discarding something, some form of energy as energy waste. The only reason I'm talking about this is because I think the UK, by the way, parentheses curriculum is really great. I was just going through this with my 12-year-old son in his science class. I was telling him, look, when you're doing transfer of energies, think of it as a light bulb. You basically created electricity. What you want is to turn on the light. The energy that you want is the actual transfer of energy, is the light itself. You're creating heat at the same time as well. The light bulb gets hot. That's energy waste. You produce that energy, you got the light, you wasted some energy. Lots of these renewable energy sources, you're producing something, you're transforming it, so what it costs or what it takes to produce the energy at the beginning up until when you use it, there's a lot of energy loss as well, which doesn't necessarily happen as much with fossil fuels where you're using it for the ultimate product. I don't know if that makes sense, but that's basically the overall view that I have in terms of both of those.
It doesn't. I think it's intuitively clear that solar and wind, for example, you can't just turn it on and off like you want. But let's talk about something where this may be possible and a source of energy that could possibly displace oil and gas in the future: fusion energy. And you know yourself, fusion has received unprecedented attention most recently and many investments. Private fusion companies raised nearly $10 billion by 2025 with startups like there's Commonwealth Fusion Systems, Helium, TAE Technologies, and some of them are claiming commercial plans in the period 2030 to 2035. So from an energy insider's perspective, do you believe fusion is a legitimate threat to fossil fuels in the next 20 years, or is it still science fiction?
I don't understand fusion to be able to even remotely explain how that would. I don't understand the downside risks of fusion. I don't understand the overall benefits. Look, any future source. Again, I don't think I perceive really any future energy as annihilation. Annihilation of basically oil and gas. I think it's going to be again plateauing of oil and gas. You're still going to end up needing it somewhere. These are really great, solutions if we're talking about fusion, geothermal, if we're talking about a lot of this stuff for Western developed markets. There are a lot of other markets where you might not be able to apply that, even if you have the energy. How do you use it in the grid? How do you bring it to basically the ultimate end consumer? I'm not sure how that whole equation works from a fusion point of view. And we could talk about basically, I'm much more into thinking geothermal is going to be a larger component of this. And I think you could see that a lot of the AI companies are doing that as well in terms of for their data centers starting to invest in geothermal itself, deep geothermal or ESG geothermal. I know there's a lot of discussion around, blue and green hydrogen, which again has its own complexities. But for me, I think geothermal is actually a source that I would rank up there as probably that has the most benefits from a financing point of view, because it's capital intensive upfront, but then every additional joule of energy you produce is a declining curve basis because the capital is already there basically at that point in time, and you're either injecting water into deep rocks basically for heat, or just through two well bores that you dug and basically reservoirs in between. So I think geothermal actually has much more of of a future for me than all of these areas. Wind is great. Again, same thing. People, I think, don't underestimate how much oil you're actually using, how much cement you're actually using to build wind farms, and where you end up with those wind farms. And do people want those wind farms on their land? Do they want them in the oceans? So just to be clear, wind is great for oil and gas industry because a lot of the technologies to build wind, especially subsea, is oil and gas. We've been doing the drilling, we've been doing the cementing, we've been doing the pipelines for decades. Wind is not necessarily, it's complementary to oil and gas in terms of even alternatives in terms of the technologies that we have. Geothermal is the same way, by the way. Geothermal, the oil and gas industry has, all the drilling technologies, has the well completion technologies, has the cementing. So I think it's okay. I understand 100% the narrative that oil is bad. I understand the narrative that basically we need to transition. I would just say there's a huge amount of technology in oil and gas. I think it's more important to probably, rather than discard the industry, help it transition to something else and use those technologies for other fuels. But it's not, again, transition for me is not that it's going to disappear. Transition for me is that the future growth of energy is going to be through renewables. Sorry, Florian, that might have been a large, but
And it is helpful. And I would like to get slightly more specific even about what you actually see on the ground. And obviously, Expro operates across the entire oil and gas well life cycle, from exploration, from production, intervention, integrity, all these life cycle steps. And your clients are the major oil and gas operators. And I'm wondering, what are they actually planning for? How do they see the future of energy?
so just to contextualize, Expro is a oil field service company. So really, it's an engineering company. We don't actually produce. So just the operators. So to make it simple for anyone that's listening to this, the operators will be the people that you see. The upstream is basically, the drilling for Shell, Total, BP. The downstream would be basically the pump, the fuel pump when you end up getting your gas. So if you look at those companies, we service those companies in terms of they decide, they go into a country, they're the ones that negotiate, let's say, the rights to a minerals plot basically, and they have to develop it over 20 years or whatever. We come in through it, exploration appraisal in terms of maybe some companies will go in doing the sonar check for what the well components are and what the well characteristics are. And then when we decide how we're going to basically go in, there's going to be the drilling, like you said, there's going to be the drilling, there's going to be the completion, which might be tubular running services to not for the well to collapse on itself. There's going to be a cementing on it to close off the well, and then basically if it's offshore, there's going to be some kind of umbilical that goes back up to a rig, and then from a rig you're going to be producing. I think if you asked everyone 2-3 years ago from a operator's point of view, everyone, I mean, look at it. Total is no longer Total. Total is Total Energy. You look at basically even other oil field services like, let's say, Schlumberger, which became SLB. They now consider themselves more as a IT or data management company. They're 100% in oil and gas, but I mean, they consider themselves more like that in terms of technology point of view to characterize the wells. And that's what they're selling. So I think there was a large shift from a political point of view as well a couple of years ago. I think it was really bad to be in oil and gas. And I think if you looked at everyone, it was basically the end of oil and gas. There wasn't going to be no growth. If you look at the new components right now, when we speak to most of these companies, everyone still sees growth up until, let's say, 24. I say everyone. Most see growth up until 2040. There's still massive amounts of capital spent in growth fields. Namibia, for example, is the next frontier where a lot of oil and gas companies are going, which is not producing today. Congo just produced its first natural gas, basically through ENI. We were part of that. It's a huge, huge project. You look at Guyana. Guyana is developing new fields, basically, because I think the world realized as well at the same time that there is energy transition, but there's also energy sovereignty and energy security. I think that became well apparent in the geopolitics that played around in terms of, conflicts in Ukraine, be it conflicts in Iran, be it, Venezuela oil coming off the market. So I think there's a lot of geopolitics as well in the energy complex. And on that basis, I think actually we're seeing 2026 as flattish versus 25, but they're still investing. I mean, they're still investing. They still have long-term capital plays in these markets that we were talking about.
Let's actually transition a little bit more to your specific role. And you're corporate treasurer at Expro, which means that you're directly involved in capital allocation, financing strategy, liquidity, and financial risk management. And I'm wondering, based on what you explained, so when a major energy company like Expro or any energy company makes a multi-billion-dollar investment decision, whether to invest, let's say, in a new oil field, an LNG terminal, etc., what actually goes into that decision? Can you walk us through the process, perhaps?
So it's a bit different. What you're talking about is more when the majors. So there's IOCs, international oil companies, and NOCs, which is national oil companies. So take it for national oil companies would be, for example, Saudi Aramco from the Kingdom of Saudi Arabia, and then the IOCs are the ones that we are talking about before. They actually make the capital decision in terms of what they're going to invest in. So they have what they call FID. So basically, they're going to go to their capital committee and they're going to determine we want to develop this field for the next 50 years because they're looking at what's it going to produce over the next 10, 20, 50 years. Does it make economic sense? How much do we have to spend from a capital point of view? And what they're looking at is not necessarily the oil price itself, but the volatility of the oil price, i.e., it's worse for them if oil is at 100, 20, 70, 30, because you don't really know where it is, than basically being low at 50 or low at 40. You know, if you're certain at a certain price, you know what you could basically extract and what the cost of that field will be. For Expro accompanies basically these IOCs and NOCs in their capital decisions. They then come to us for the solution. So Shell, for example, does not have a drilling company. Shell does not have a completions company. Shell does not have the rigs. Think of them basically as almost, I don't want to downplay it, but what they're doing is basically they end up getting access to the concession and they bring everyone on board to pitch, say, here are the services that we could provide to you to operate the well itself. And then they're the overall operator. Expro doesn't do build to market. We don't decide to spend capex on basically blue ocean or whatever. The capex that we spend is to accompany certain projects. Now, how do we decide which projects we're going to accompany? That we have internally what we call a business evaluation review, a BER, where you have basically the heads of operations, you have financing, you have the CFO, so COO, CTO, CFO, and Treasury from a risk point of view in terms of what can go wrong. And the decisions are made of what we're going to bid for those projects more than where we're going to go. The only capital allocation that you're talking about that really is made here at Expro is more which countries are we going to serve. Does it make sense, for example, to go into Guyana, follow our customers into Guyana? Does it make sense to follow into Argentina, given the, maybe political, now it's not the same, but political situations at the time or economic situations at the time? Those are the kind of decisions that we make. Where do we accompany our customers, and with which services, more than basically, are we going to develop this field or not? We try not to take operational risk in terms of, we don't know if this well is going to be dry or not. We go in to basically either optimize the flows or we will go in to help monetize the flows of the wells.
In your career, you worked at different capex intensive types of companies in different industries. And the common narrative that we hear, and our audience would appreciate that this is what they teach you in finance classes or in business school, is that you would project future cash flows that you expect from a given investment, that you discount them back to the net present value, and then you have your internal rate of return, and you either say, yeah, this is acceptable to me, or this is not acceptable. From a practical perspective, to what extent is this really how investment decisions are being made?
Look, for us, 100%. Our BER process is exactly that. So from our bid evaluation reviews, what we do is we say, here's what we're going to be charging from a capex point of view, and then lease, operate, and maintain. So once the equipment is there, basically how we're going to be leasing over time. And at that point of view, we're really looking at, here's a revenue we think we're going to be gaining. Here are all the overall costs. Here's our weighted average cost of capital throughout. Are we NPV positive on the project? Are we generating returns that are commensurate with the risk of basically going into the country? We're not going to expect the same return if we're supporting a customer in a new frontier type operations versus somewhere where we already have a base, where we know the terrain, the geology we have facilities. So all of that goes into consideration. Do we still make decisions that sometimes, and this is where it's odd because I think that in school what they show you is you pick the best NPV project. Yeah, that happens if basically you have three projects that happen at the same point in time. You have to make a decision at some point in time. You have one project, and this kit might be utilized in five. It could be used now, or maybe you win a bid in 5 months' time. You don't know if you're winning that bid. Are you willing to forego today to say we'll keep it aside and hopefully win the future, even if that's a higher NPV project? Not necessarily. I mean, you're still looking at basically cost absorption. You're still looking at basically having, high asset utilization throughout the organization. So it's not just a question of NPV. You want NPV projects, NPV positive projects. We always try and strive to get NPV positive projects, but you could decide to go into a country and, lose money for a couple of years to get market share in that country. That's also positive. It's possible. You could decide to enter a new market with the knowledge that you're going to have to invest to get market share, and that's not going to be NPV positive upfront.
That's an interesting perspective. And let's assume that we're in a perfect world. And as you teach you,
Big
you have
assumption.
three projects, you're comparing them.
Yeah.
Maybe they are all NPV positive. In this perfect world, what would be the minimum target rate of return that you would want? Not necessarily at Expro, but what do you see in the wider industry?
I think this is where we're really good as a species to try and get to one specific answer, try and get very simple and this is the one. If I hit this KPI, it's done. If I hit this NPV, it's done. Without going into AI, so you end up with basically break it down to this is the decision making. You can have a super positive NPV, but it's over 25 years, and a less positive NPV, but the project's over 3 years, and it's less capital intensive. At that point in time as an organization, you can have a very positive NPV project and decide not to take it because from a risk point of view, so much could go wrong over those years that you're not sure if you're actually going to ever end up materializing or achieving that NPV. And you don't even know if you could finance that NPV project sometimes, right? You could have some very good projects that is not in the DNA or is not in the composition of your company. You decide not to take it from a risk point of view. NPV is not the see all end all. It's a metrics that you can use to basically decide if you're gonna be investing. Technically, if you go through NPV, it basically means that your returns are going to be higher than your cost of capital, higher than your weighted average cost of capital. Theory goes that if you have unlimited financing, all NPV projects, NPV positive projects should be financed or should be invested. We have a finite or discrete amount of financing. You're not going to fund every single positive NPV project out there. And you shouldn't, and you can't. You're going to be, you could look at the project, you have to understand what it means as well in terms of the overall organization, in terms of changing the culture of the organization, in terms of, stretching the organization itself. So I would say on the face of it, the higher NPV project is always the one that you go for. Yes, that's common finance theory. Don't walk away with this thinking that as soon as it's an NPV positive project, it means that you just go for it. Does that make that we're going to have a different our cost of capital is going to be different to some of our competitors. We're going to have different expectations basically on returns on projects. That's just the reality of it.
And I do understand and appreciate the answer. It was not what I was hoping for, though.
No, I agree.
And I will try a third time to really pin you down.
Yeah, sure.
Domenico, you have two projects.
Yes.
One project is over 5 years and it gives you, let's say, an 8% IRR. And the second project is over 10 years and it gives you a 10% IRR. Which one would you choose?
You're going to go with all other things equal, you're going to go with the higher IRR project. You're going to go with the higher IRR. If it's securing basically longer cash flow for a longer time, you're going to go with the higher IRR project. But again,
even though, as you said earlier, it's a longer time, there are potentially more risks involved, more forecasting risks is less certain.
Yeah, look, I think that different environments warrant different types of projects that you accept and what you're willing to to take on in terms of in the environment right now. Would you be willing to take a long-term stream of cash flows? Yes, I think that you would. Again, if it makes sense from an economic point of view.
I take that as an answer. Now let's actually move on, and we touched on this a little bit already. Geopolitical uncertainty, global complexity, these are all at an all-time high, right? There are wars in Europe, in the Middle East. There are the US-China tensions, now Venezuela, the sanctions on Russia, and the list goes on and on. And oil and gas are deeply political commodities. They are also highly relevant from an economic perspective. Now, how do geopolitical risk factors factor into the long-term planning and capital allocation investment decisions that you're involved in?
Yeah, I think that, look, it's oil and gas is always going to be geopolitical because you're not producing oil and gas in the middle of London, right? You're always going to be in areas that are hotbeds for the most part. Uh, I mean, there are very great stable countries that are producing oil and gas, but overall, you're always going to be in more remote areas. You're always going to have basically geopolitical risks in terms of access or in terms of deployment. I think that for us, we've made a conscious decision that most of our operations, or where we try and strive as best possible, is actually on offshore oil and gas. The reason why offshore is for us is good is because it's lower barrel cost over time. Again, you basically spend the capex up front, but then it's for a very long term. Very difficult to disrupt them because they're offshore. You're not in the middle of a country that basically has political conflicts. And it's high technology barrier for the most part, so we're able to extract in that part a higher margin. There's always going to be higher margin in offshore than there's going to be in commoditized onshore. In the US, for example, we don't play in the US land, for example. We play in US offshore, but not in US land because it's a very commoditized market where people aren't willing to pay you a premium for health and safety, for example. So to your question specifically of geopolitical, I think that the geopolitical that we look at more is in terms of where you're actually gonna be following your customers. When you go into Iraq, for example, you're gonna have security risks. Who's paying for the security? But if you're an oil and major or for an oil and gas company, you're gonna have to be in those environments. So if you wanna basically get oil and gas, you're gonna have to be in environments that are not necessarily the most stable. I don't think that answers your question, but that's my answer.
Thank you, and it does. And you mentioned again that long-term planning is very important, that you're making long-term decisions. And one of the other very profound shifts that I believe we see in the energy market right now is the explosion in electricity demand driven by AI and data centers. And electricity demand is projected to grow faster than overall energy demand. Now, if you think about that, for the time being, it is not entirely clear yet if and to what extent AI will be useful to organizations in the long term. And yet at the same time, you have this rising electricity demand. And as you explained, you have to make long-term decision. How do you balance that?
I think those are being balanced themselves by there's a huge amount of investments being done by, be it Meta, Google, any of these institutions that are trying to basically corner AI and basically bring it to masses, basically, and have it grow. And that's where you see them investing long term. I think in geothermal, you see them investing in multiple different types of energy sources. Again, this is the growth in consumption due to a specific need in terms of AI. That's what I was talking about at the beginning. I think that all of those extra sources will be probably financed and will be catered to based on transition type energies. That's not going to be fueled through oil and gas. Might be fueled through gas in terms of gas plants to a certain extent, but not through oil. So that growth is going to be renewables in my view. It's not going to be tomorrow though. I think that to bring to production is going to take at least 5 years. right? In terms of the grid that you need. It's one thing to say you're going to have all this energy. It's one thing to say you're going to produce all this energy. How are you going to distribute all this energy? The U.S. has something in some of the numbers that I've seen or some of the reports that I've seen. The U.S. probably has $80 billion worth of investment that they need in the current grid for the numbers that they're talking about in terms of AI in the next 5 to 6 years to basically accommodate that type of energy surge. So it's great that we're producing it. We might be capped at some point in time, not in terms of production, but in terms of distribution of that energy. But that's a utilities type discussion, not a producers type discussion.
And I think it's actually worthwhile to compare different situations. And over your career, you've lived through multiple energy crises and commodity cycles. We talked about the Lehman Brothers collapse 2007, and as a consequence, the 2008 financial crisis, then the 2014 to 2016 oil crash, the COVID-19 demand collapse, and now this period where we have energy transition, well, uncertainty, global geographical complexity, rising demand, AI, etc. If you think about these different types of transformation and crisis, what differences are there compared to previous cycles from today?
I think it's interesting because well, first of all, I haven't been through that many cycles. I'm very young, Florian. Let's establish that from the start. But now, in terms of crises and in terms of overall timescale, I think that the human psyche is great at thinking that this is so different, right? We went through. There was the internet came. I remember when I started my career. This is aging me, but when I started my career, the first Blackberries came out.
Was about
Blackberries.
80 years ago, right?
Yeah, that was 80 exactly. That was exactly. So and it was we moved away really quickly from BlackBerry to iPhones and sorry, I'm going to say Android or iOS type phones very quickly. I mean, we've adapted. The world changed. It moves quickly. It's not going to be. It's not. I don't think it's very different to anything in the past. At the end of the day, for me, again, I go back to Vaclav Smil. Everything is, energy is the global currency. You're going to be constrained as a society by how you can grow, how you can basically develop based on how much energy you're able to produce and how you're able to consume that in a efficient manner. What was limiting basically historical societies in terms of the size of a the size of a city was what agriculture and was basically energy. You had to have a forest that was gonna be 10 times the size of your city to basically have the energy that you need. We've moved away from that. Energy sources are becoming much more efficient. Energy sources are being distributed much more efficiently. I don't think that there's going to be, this is any different to basically the past. Technology for me is going to somewhat answer some of these cyclicalities that we're talking about. The real question is going to be who's paying for it and who's going to be willing to pay for it as well. That's where basically there's going to be more tensions from a government point of view, maybe than in the past, because I think we are probably right now at an influx where societies themselves are much more polarized. I think that's more the difference than the actual energy cycles. Is that uh, again? That was maybe a tangent, but
Yeah, and along these lines, along the lines of what you explained, and thinking about the future and making strategic bets. I think another fascinating development that we see in this whole environment at the moment, and I hinted towards this earlier, is that, well, some of the major energy companies are investing in renewables and in fusion as another example. So Chevron-backed TAE Technologies, a fusion company, and Shell invested in other fusion companies, and oil giants are partnering with these fusion startups. And to me, it almost seems contradictory. At the same time, it seems strategic and possibly as a hedge. From your perspective, and possibly even from what Expro is doing, are you making strategic investments? Are you trying to invest in startups to get ahead of the curve in terms of the energy transition?
yeah, look, I think let's put to that point, right? This is a Schumpeter's destructive creation type. If you take the S&P 100 years ago, none of those companies are here today, right? But some of them have evolved. If you take 3M, for example, Minnesota Mining Company, it was a mining company that became basically, abrasives company, which became what we know today. Maybe people are thinking of post-it notes or whatever, but they've evolved over time. Clearly, the oil majors, OFS companies, are looking at we invest in multiple technologies, be it geothermal, be it gas compression type technologies. Um, you have to basically, as an industry, evolve because that's where the growth is going to be as well, and because you need an energy transition, right? I Not everyone in the oil field services, let's be honest, will believe in basically global warming. I believe in global warming, and I believe that basically we have a role to play in it in terms of reducing global warming. So therefore, we're going to have to invest in these technologies. There's the other side of it as well, where as a society, we're probably going to have to consume a bit less. Now, to your specific question of basically um, hedging their bets or basically investing, something is really interesting in terms of the way that oil and gas companies are being funded today. Let's just start by there, and then that will probably explain the second part as well. Oil and gas currently represents 2.5% of the S&P. NVIDIA represents 7.5%, right? So NVIDIA is bigger in the S&P 500 than the oil and gas complex as a whole. Since 2019, basically there hasn't been an oil and gas company, I think, in the top 10 in terms of the S&P. When you look at funding of oil and gas companies today, if you look at back to what you were talking about in terms of from a academic point of view, terminal growth value, or basically private or multiples, basically in terms of PE multiples, it's never been lower. Oil and gas has become a yield industry with no duration, i.e., people are not investing in it as something that's going to last the next 100 years. Irrespective of whether it will, there's no value in that terminal. When you do the terminal value growth models, there's no value in that terminal growth. And we're looked at as basically a yield company, i.e., generate cash, which we're generating a lot of cash, and buy back your shares because basically we want yield. We want basically a cash back. Some of these companies have basically tried to go 100% renewables a couple of years back. Some of them got punished from a market point of view because they're saying, well, that's not generating the cash that we want. So I think that the way that many of these companies have addressed that is either by splitting off the renewable side or by investing, as you're saying, directly into these technologies as joint ventures or basically as investments that they have for their excess cash. But I think, look, the oil and gas industry is moving towards transition, it is moving towards other energies, is investing in other energies. Because for the most part, the same technologies that you have are needed in all of these other types of energies. In geothermal, you need the drilling, you need the directional drilling, you need the completions. In wind, you're going to need the offshore expertise of oil and gas. So most of these transition energies still need the expertise of oil and gas industry. I think all the companies are investing, all the companies are doing transitions. We're seeing it, to the exception of maybe local US, basically fracking type companies. But the larger companies are investing in transition. The larger companies are investing in alternative technologies.
Look, and I think it makes perfect sense to keep a very, I would say, balanced hat on, because none of us, nobody can really look in the future, especially not 5 or even 10 years out. But perhaps if we zoom out from this discussion, like really assume like a macro view, if you had to place a bet on which next generation energy technology could possibly scale to commercial significance, say by 2040 or 2050, whatever you prefer, what would you bet on?
I'm going to say, from a pure finance point of view, capital flows where it's welcome, i.e., where the regulations are lower, where basically there's returns to be made, where there's a declining cost curve over time. Just because of the amount of cash that's being deployed here and the potential lower side risks, I again would be much more into the geothermal than anything else.
Interesting.
Because you could do geothermal in very stable economies. Geothermal is being developed in the US. Geothermal is being developed in Norway. Geothermal is being developed in countries where basically you could immediately access the market as well, right? It's from a sovereignty of energy point of view, high capex up front, but once it's produced, it's there. You're turning it on, turning it off. Now, there's going to be other risks with geothermal that we're not talking about today. Geothermal, realistically, there are different types, either with pipes where it's almost like an upside down radiator in the ground, where basically you're flowing water in, it's heating, it's coming back up, and it's circulating a turbine. There's going to be questions about the water use, right? Because we're talking about energy. There's the other component. Some of these energies are going to be using as well a declining commodity or a more valuable commodity being access to water. And then from a geothermal point of view, it's fracking technology, ultra deep rocks, high pressure type environments. Is it going to cause, and I don't know, I'm not an expert on this, but we've seen it from a fracking point of view. Does it cause earthquakes? Does it cause you release basically tensions and basically ultra deep rocks that then intentionally create more unstable or more, and are people going to be willing to accept that? But look, given the fact of the amount of money that's being deployed and the regulations that are changed in the US to accommodate this, and I'm not giving it investment advice, I would be more on the geothermal side.
If we were to make this like really practical, imagine that you're advising, let's say, a mid-career professional who wants to build a career in energy over the next 20 years, 30 years, 40 years, however long we will have to work. Given everything that we've discussed, the uncertainties, the technological shifts, the geopolitical risks, what skills should these professionals focus on to develop? Where are the real opportunities for people who want to be positioned at the intersection of the future of energy and, well, finance?
I don't know how to answer that question, so I'll start off by maybe the skills I think that you're going to need more than the industries themselves. So from a skills point of view, I have 2 young kids, and all I'm trying to do for them is, resilience. All that we're certain is that tomorrow is going to be different than today. You can't prepare for tomorrow with the tools of today because tomorrow is going to be different. So I think people have to be willing to go into the market with basically an open mind that things are going to be changing, and basically that's okay, right? Make strong ethics. Things are going to change. Be prepared for change. And in terms of to your second question, I think you're saying where in terms of what the industry will be more. I'm not sure I understood the second part of that question. Which industry is going to be more buoyant, let's say, or what's the future from where should you be from an industry point of view? Is that the question?
I mean, it goes a little bit into the direction of what we discussed earlier. If you're a mid-career professional and you want to, maybe you are already in energy, you want to stay in energy, and you're looking at the next 20, 30, or 40 years of your career, would you advise this professional to go find a job in oil and gas or elsewhere?
Look, I'm in oil and gas, so I can't tell people don't go into oil and gas. Oil and gas still has tremendous opportunities to the extent that you are in an organization that is willing to adapt. The extent that you're joining an oil and gas industry that has, R&D department that basically is investing in alternative solutions, that is basically dynamic today. I would say yes, go to those types of companies. To the extent that you're just going to be in a oil and gas major that it's only oil and gas, there's nothing else out there, that's going to be a very commoditized type industry over time. That's going to be like going into coal mines at this point in time. So if you're going to pick an oil and gas, there's still tremendous opportunities in oil and gas. There's still huge technologies in oil and gas. There's incredible people I meet every day in terms of in oil and gas. As long as basically you're going into a company that, again, is actually making these decisions for the future, not just staying status quo.
Interesting. And you said something that sparked my curiosity a few sentences ago.
Yeah.
In terms of the skills to cultivate, you explained resilience would be a key skill. How do you build resilience?
I can't speak to anything other than what I'm trying to do with my children, at least. I think in kids, it's basically you have to be willing to be bored. You have to be willing to admit that you can be wrong. You have to be willing to take chances and see how it plays out in terms of effort. I make my kids do a bunch of sports which cost me a fortune. I don't spend the money because I want them to become professional athletes. I spend the money because I want them to know what it is to win, what it is to lose, what it is to play as a team player. So I think resilience is basically get off sometimes the phone in terms of always looking for AI to solve everything. Go meet people, go have discussions, and especially go somewhere where you know nothing about it, right? Be be the smallest fish in the biggest pond at least once, in your life. Go speak to people, try and understand other people's perspectives. I think that's the way that you're going to build over time resilience, and have a realistic view of what you expect. I see today a lot of brilliant mid-career or early career professionals coming in and saying, okay, I'm going to do this for 1 year. And what's my next step right away? They want immediate recognition. And it's kind of like, well, I'm not going to be able to give you that. There's no way that I don't know how you're going to be able to get that other than if you go on your own and maybe start your own company. Maybe that's what you're looking for. So I would just say that again, resilience, you build it through a better understanding of actually what you want and yourself. And then through the fact of, I think, interacting with as many people as you can. I don't know what's your point. I
That's
don't
an
know
interesting
what your view on
perspective.
resilience is, Florian.
Yeah, it is an interesting question, right? And I would say resilience is the result of overcoming challenges over the course of your professional career, right? They say that diamonds get forged through heat and pressure, and I see resilience as a product of that. You're exposed to a problem, you're exposed to a challenge, you're going through a hard time, and well, maybe in the beginning you think, oh, it's going to be very, very difficult, and maybe I can't do it. But then you find out, well, you're more resilient than you think at this time. You overcome the challenge, and the next time when you're exposed to this type of challenge, you'll be less exposed,
I
right?
don't
You're more
see.
confident in what you can do.
Sorry, now we're going more into philosophical debate here, but I think that's what actually having that mindset that you're always going to make it through. I don't think actually creates I agree with you in terms of the pressure creates a diamond basically. The pressure also crushes the rock sometimes. Too much of it basically might not be great. And I think our society always looks at you created a diamond. You see YouTube, what happened, everyone sees the success, and no one is willing to admit that failure sometimes is part of the process as well. I think resilience is actually expecting to say, I'm going to try my best to make it happen. I'm going to try my best to develop it to get to the end result. If it fails, it fails. That's not, obviously, that's not the way that we look at it from a finance point of view, just to be clear, right? But I'm just saying you have to be willing to accept that basically not everything is going to go exactly the way that you want it.
And don't get me wrong, I'm not trying to say that overcoming a challenge means succeeding
Yeah,
in that. It means overcoming
yeah,
it,
fine.
not
Then we
regarding
agree.
the result.
Then we agree.
But then, I mean, for the next time, you know that how you as a person, as an individual, how you would react. Maybe you have lessons learned from the past. And I see it in myself when I look at my early career days and I compare to today. I'm definitely much more resilient. It would be, well, remarkable if I
It,
wasn't.
it, it,
But this
it would be concerning.
experience,
It would be concerning if it was not the case, Florian. It would be concerning. I think everything is, when you're younger in your career, everything is, oh my God, this is the end of the world. As you grow, you realize that no, there's a tomorrow and you're going to get through it.
good. Now, if we move on, I want to talk about mistakes and failures a little bit. And I think it touches nicely on the resilience discussion that we just had. Can you share a mistake that you made in the past, possibly a misjudgment or a situation where you would say, I failed? Can you explain a situation as that? And more importantly, what you learned from that?
Look, I'm going to go back into the context of, yeah, I'll give you a failure. Um, I think we were talking about Oxford before, and I told you I would live it differently probably. Oxford in itself was not at all a failure, but I think I would live it more in terms of just living the moment. The moment's past, enjoy the journey, and go deep into it. I think that very often where I failed is basically not not being present in the moment sometimes, not being present, um, be it either for the educational journey that was Oxford, for example, or for family or whatever. You make choices in life. Those are all fixable over time. In terms of decisions that where I failed, most of the failures that happened in finance, or let's say in Treasury, was not because I didn't know what had to be done, or it's not because I couldn't execute on them. It's because from a timing point of view, the timing was not right. We talk about crises. You know there's going to be a crisis at some point in time. It's inevitable. There's going to be a funding crisis at some point in time as well in any organization. How you prepare for it basically is really important. I think I've left myself a lot of work sometimes on certain things because, trying to be too correct maybe with certain employees, right? Letting certain things go because you say I can't reshuffle my organization or stuff like that. Over time can create issues.
And that's a good perspective. And maybe one thing to touch on, you spoke about timing, and they say you can't time the market. And most of the times, in hindsight, whether or not the timing was correctly. So when you mistime decisions, what do you actually learn from that?
Look, I think that for me, it's basically you're not going to catch it back up. I think the reality of it is the best time was yesterday. The next best time is today. So yesterday passed. All you could basically do at this point in time is look at the situation as it is right now. Don't sulk on what basically passed by behind you, right? What's gone is gone. They say the past doesn't exist. The future doesn't exist yet. All you have is the present. So you can't sulk on basically the missed decision prior. You have to live with what you have in front of you today.
That's very powerful.
I don't know, but that's my view.
Okay, let's actually start wrapping up our interview, and I have two final questions for you. What or who is inspiring you right now? Like, is there a particular leader, a book, an idea, or even a challenge that you're facing that is expanding your thinking?
Yeah, I think, look, I'll turn it into basically, this might be a boring answer, but I come from a family whereby my parents were, Southern Italian economic migrants, basically. They left to Canada. They didn't speak the language, had no one there, had to build from scratch. We were 4 kids. They sent us all to university, and for them, it was basically the most important thing was basically never stop learning. They'll never have, we'll find a way economically, but just never stop learning. And I was really lucky because, brought up in a middle class family. I never saw my father complain once in his life, and he would have had lots of stuff to complain about. So I think that I don't try and look at heroes very far out from my inner circle. I think I try and find them within family because there's a wealth of strength there. In terms of basically, again, something that I'm reading right now, if I look at the last couple of books that I have read, I love reading from a human journey perspective, Dostoevsky. And that's it. I'm more of a, more trying to gravitate around leaders than anything else. So I can't name one leader right now that I would say is an inspiration.
Kudos to your family.
Thank you.
Well, and then Domenico, if listeners remember just one thing from our conversation, one insight, one way of thinking differently, or one action they should take, what would you want that to be?
Dive in. Just, I've seen many people around me all the time not take opportunities that they should have taken because they basically think they're not ready for them. Just dive in. You're gonna grow in the organization. You're gonna grow basically your we're talking about resilience, but basically your competencies. Just do it. Up until you do it, you don't know if you can or you can't. That's what I would say.
Domenico Sansalone, thank you for your time and for this conversation. It was great to have you.
Thank you, Florian. Same.
Before we wrap up, let me highlight what I believe are the key insights from this conversation with Domenico. Energy really is the world's essential currency. Despite all the noise about renewables and exciting breakthroughs in new technologies, oil and gas are still at the heart of global energy use, embedded in the very fabric of our lives. What we are seeing isn't necessarily a revolutionary switch, but a slow and complex transition. New energy sources just keep joining the mix while older ones, oil and gas, don't really disappear. They just find a new place over time. One thing that truly stood out is how the future of energy isn't just about innovation. It's about the messy realities of infrastructure, the challenge of storing and moving power, and the raw practicability of bringing energy to where it's actually needed. Solar and wind are important but face real-world barriers. Our systems today are built with oil and gas at their core, and shifting them takes much more than just political will or technological progress. What's happening in the decision rooms of major energy companies is nothing like the public debate. Here, strategy is about balancing risk, seeing crisis as inevitable, and preparing for uncertainty. The real differentiator isn't being able to predict the future, it's having the flexibility, the strong relationships, and the readiness to adapt when things change quickly. Sometimes being able to weather a downturn is just as critical as betting on the next big thing. The next era of energy won't come from picking one winner, but through a messy, all-hands-on-deck approach. Fusion, hydrogen, geothermal all have a place, but each with its own hurdles. There's no magic solution, and even groundbreaking advances take time to be felt far beyond the headlines. Maybe most memorable is Domenico's view on careers and leadership. The lesson wasn't about a single right answer or the perfect plan. It was about staying open, being willing to make mistakes, and then learning quickly from them. Adaptability combined with the courage to say yes to big challenges matters more than any one technical skill, especially when the future is so unpredictable. Resilience really matters, and ultimately, the most successful people aren't those who never fail, but those who learn, recover, and keep moving, even when the path ahead is far from clear. Now, a few final words. If this conversation resonated with you, whether you're thinking about energy investments, if you're curious about how billion-dollar decisions really get made, or simply want to stay informed about one of the most critical energy transitions reshaping our world, please don't forget to subscribe, like, comment, and share. You can also head over to businessunbound.co. That's where you'll find links to everything we discussed today. And while you're visiting our website, I'd like to encourage you to subscribe to our newsletter to get notified when new episodes come out. You'll be the first to know when we are dropping conversations with the next wave of forward-thinking leaders who are shaping industries and challenging conventional wisdom. Thanks for listening. This was Business Unbound for today, and until next time.